Welcome back, guys. My name is Angelo. I think it's time we finally discuss what has been going on over the past couple of weeks in the banking sector and if there's any reason to be worried regarding the safety of your bank deposits or investments. I'm of course talking about all of this from the perspective of a European investor, as I myself am based in Austria. So let's begin with a short recap of what happened so far, not only in the US but in Europe as well. It all started with the Silicon Valley Bank in the US, which made the mistake of investing a large portion of its customers' deposits into long-term government bonds over the past few years to earn some interest on them. They purchased many of these when they were still paying very low interest rates, barely above 1%. That in itself is fine, but here's the issue. Since yields for US treasuries increased at record pace to 3-4% or more over the past year, older bonds with a lower interest rate, like the ones they owned, were now worth less as a result. By the way, the same thing happened to Euro government bonds. Normally, as long as you don't have to sell those older bonds and as long as the US government doesn't default on its debt, you still get back the full principal at the end of the loan term, as well as interest payments twice a year. Well, the worst case scenario happened. On Wednesday, March 8, the bank was still in solid financial condition according to regulators. Just one day later, on Thursday, March 9, there was a massive bank run with customers placing withdrawal requests for over $42 billion within just 24 hours. As a result, the bank was forced to liquidate some of those bonds right away, resulting in significant losses. At the end of that day, the bank had a negative cash balance of nearly $1 billion and couldn't cover its outgoing payments anymore. This led to federal regulators closing the bank and taking control of it the following morning. With over $209 billion in assets just a few months earlier, Silicon Valley Bank was the 16th largest bank in the US, which means this was the largest bank failure since the financial crisis in 2008. But here was another issue. Countless startups in Silicon Valley exclusively used that bank, with 94% of deposits being above the FDIC insurance limit. FDIC is similar to our deposit guarantee, with the main difference being that it's protected up to $250,000 in the US, while it only goes up to 100,000 euros in Europe. As a result, something unprecedented happened. Instead of 94% of depositors losing money, the Fed stepped in and guaranteed all deposits, no matter the amount. That same day, Sunday, March 12th, the Fed took over another bank, Signature Bank, which was now the second largest US bank failure since the financial crisis. With many small to medium-sized banks seeing large withdrawals due to fear of more failures, the Fed launched a major lending program for all banks, allowing them to get cash advances from the Fed by pledging their treasuries, bonds and other debt as collateral instead of having to sell them at a loss to meet withdrawal requests. In a way, this means the money printer is back on even while rates are still high. Here's what I mean. Between April 2022 and March 2023, the Fed managed to decrease its balance sheet by $626 billion to fight inflation, and now, within just 2 weeks, 62% of that amount, $391 billion, had to be printed to deal with the current banking crisis. Meanwhile, in Europe, we almost saw a major bank fail as well, this time in Switzerland. Credit Suisse was on the brink of insolvency before being taken over by UBS for $3 billion, with the Swiss National Bank getting involved and providing more than $100 billion of liquidity to help facilitate the deal. And now people are becoming increasingly concerned regarding other banks as well, one example being the Deutsche Bank in Germany. Luckily, it doesn't seem to be in too bad of a financial position after all, according to analysts, so we'll have to wait and see. Either way, this one is systemically relevant for the banking sector, so I'm sure governments would step in once again if necessary. So yeah, the last couple of weeks have been pretty intense, and if I had to guess, I don't think we're done with the banking crisis just yet. So what now? Should you be worried about your bank deposits and your investments in ETFs, stocks or P2P lending? Here's my take. Let's begin with bank deposits, i.e. cash in euros. The bank deposit guarantee in Europe protects your funds up to a maximum of 100,000 euros per account at each bank. So in my opinion, as long as you're below that amount, I don't believe there's reason to worry. Nonetheless, you could still be in an uncomfortable situation if your bank fails, as you might need to wait a few weeks to regain access to your funds. As a result, I would make sure to keep a few hundred euros in cash at home for emergencies and living expenses, and potentially open a second account, preferably a free one, at another bank, which you could use if needed. In case you're interested, I have several bank accounts myself, which I opened over the years. The ones I use the most are a pretty standard boring Austrian bank account for general bills like our rent, Revolut for fast transfers when traveling and for purchases in other countries, and Trade Republic to earn 2% interest on my cash. Okay, I can't actually use the last one the same way I would use a bank. I can only move money back and forth to my other bank accounts. Still, it's covered by the same 100k deposit guarantee, so I figured it was worth mentioning. Now, what about stocks or ETFs? Are those at risk? Well, they can certainly swing up and down in price, as we've seen over the past couple of weeks. But the most important thing is that these securities cannot be touched in case of bankruptcy, as they are held separately from each broker in custody exclusively for you. This is why high net worth individuals with cash reserves above 100,000 euro, the deposit guarantee limit, actually keep those in bonds instead of cash. Bonds are securities as well, just like stocks and ETFs. This means that once again they exclusively belong to you and they are segregated from the bank's or broker's assets. Thus, in case of bankruptcy of a bank or broker, all the assets you have in the form of stocks, ETFs or bonds remain unaffected and still belong to you and can be transferred over to another brokerage account of yours. The one risk in this scenario I do see is when share lending is involved, for example with the two brokers DEGIRO and Trading 212. Even though your shares are lent out against collateral, there's still a bit of counterparty risk in case both the borrower as well as the broker were to go bankrupt at the exact same time. This is why I appreciate that there is no share lending by default on my two favorite brokers in Europe, Interactive Brokers and Trade Republic. You can find them linked down below in the description, by the way, in case you'd like to check them out for yourself and support me. And before some of you ask me in the comments, no, there is no share lending on Scalable Capital, Smart Broker or FlatEx either. 3 more brokers that I've mentioned on the channel before and where my wife and I have some of our ETFs. If it was up to me, I would also pick physical ETFs that actually hold the stocks from whichever index they are covering, instead of synthetic ones which replicate the index's performance via swap contracts. While these are collateralized as well, they carry some counterparty risk. According to UCITS regulation, this counterparty risk with synthetic ETFs is limited to a maximum of 10% of the fund's assets, but it's still worth knowing about. To summarize, make sure you pick a broker that is strictly regulated in Europe, like the ones I mentioned, and that thus exclusively custodies your stocks, ETFs and bonds separately from the company's assets, doesn't lend out your shares, and stick to physical ETFs if possible to reduce counterparty risk with your investments. If you do that, it doesn't matter if your broker of choice ever runs into financial trouble, you'll maintain full access to your shares as they can simply be transferred over to another brokerage account of yours. That's a major difference to cash you deposit in a bank account where you're basically loaning your money to the bank itself, which then invests part of that money or lends it out to others to earn interest on it. Which is why bank runs can financially bankrupt a bank within a record amount of time, as we've just seen. Meanwhile, if 100% of investors were to remove all of their stocks and ETFs from what I consider to be the best broker in Europe, Interactive Brokers, the broker would remain financially stable. Okay, enough about stocks. What about peer-to-peer lending? I think the banking crisis could be both good and bad for the sector. Let me explain. If banks restrict the amount of loans they issue to individuals, as is happening right now, this means these individuals are now more likely to look for loans elsewhere, including the P2P sector. Since these borrowers would have previously received a loan from their bank, they are most likely of higher creditworthiness and more likely to repay their loans on time than the average peer-to-peer borrower under normal market conditions. The same could be true for business loans. On the other hand, refinancing likely became a lot harder as well. For example, someone might have taken on a peer-to-peer loan, hoping that he or she would be able to replace it with a bank loan later on at a lower interest rate. However, the combination of central bank interest rates increasing at record pace and the current banking crisis now make this a lot less likely. Ultimately, I think this is not the time to simply go after the highest interest rate and to take on excessive risk, but to instead focus on profitable, transparent lending companies wherever possible. Since I tried to do that already, I haven't changed anything in my own P2P portfolio. And that pretty much concludes my take on everything that has been going on over the past couple of weeks. If you found any of it helpful, feel free to use my links down in the description below to some of the things I mentioned in the video. Apart from subscribing, of course, if you haven't already, so you don't miss any more upcoming finance videos specifically for European investors. I also wanted to mention that I generally don't like to create videos spreading panic like many other channels do. The news have done enough of that non-stop for the past 3 years already, and I doubt anyone needs more. That's why I typically don't react to every little thing that happens, as it generally leads to bad investment decisions, and I prefer to stay focused on the long run. Anyway, thank you guys so much for watching, have a wonderful day, and until next time.